Ready to start trading penny stocks? Before you dive in, there are key fundamental metrics you need to understand to make smart, informed decisions. If you don't look into these, let's just say your money won't last very long in your value portfolio. Let's break down 10 stock fundamentals every penny stock investor should know. First up, the profit margin tells you how much profit a company makes on each dollar of sales. A higher profit margin means the company is more efficient at turning sales into actual profit. For penny stocks, a solid profit margin is often a good sign that the company's worth considering. More than anything, a high profit margin indicates a good management team. And the importance of good management cannot be overstated in the microcap world. On that note, insider ownership refers to the percentage of shares owned by the company's executives and insiders. High insider ownership shows that the company's leadership is invested in its success. This can be a positive sign that the leadership believes in the company's future. Think about it. Would you be more invested in the success of a company you own shares in, or the company you work for but don't own? Personally, I like to see 20% insider ownership when investing in penny stocks, especially those on OTC markets. Earnings per share. Earnings per share is a financial metric that shows how much profit a company makes for each outstanding share of stock. It's calculated by dividing a company's net income by the number of shares in circulation. Admittedly, this is more important for growth investors than value investors, but I still like to see the EPS on an upward trend when investing in value stocks. EPS is used by investors to measure a company's profitability and is often used to compare performance across different companies in the same industry. A higher EPS typically indicates a more profitable company, which is generally a good sign for investors. EPS equals net income divided by outstanding shares. It's that easy. For penny stocks, understanding EPS can be crucial because it helps gauge whether a company is generating sufficient profits relative to its stock price. Next up, the PE ratio. This stands for price to earnings ratio, and it tells you how much investors are willing to pay for each dollar of earnings. You can calculate the PE ratio of a stock by dividing the share price, that's the price the stock is trading for, by the EPS price. A high PE might suggest that the stock is overvalued, while a low PE could indicate an undervalued stock. The numbers will vary from industry to industry, but a PE under 15 is generally a good sign. Before we break into some big brain financial jargon, if you like this video, please hit the like button, subscribe to the Trade Tea, and comment your favorite financial metric, or whatever. Back to the video. Next we have the PB ratio, or the price to book ratio. This measures a company's market value against something called a book value, which is the value of its assets minus liabilities. By investing in stocks with low PB ratios, an investor can actually purchase the tangible assets of the company for less than their worth. A PB ratio under 1 could indicate that the stock is undervalued, but always compare it to other companies in the same sector. The PS ratio, or price to sales ratio, shows how much investors are willing to pay for each dollar of sales. If the company isn't profitable yet, this can be an important measure to assess its growth potential. Investors like this measurement because it can't be manipulated. A lower PS might signal it is an undervalued stock. Free cash flow is the cash a company generates after expenses and investments. This is crucial because it shows if the company has enough cash to reinvest, pay dividends, or reduce debt. Positive free cash flow is a good sign of financial health. Honestly, a positive free cash flow is one of my non-negotiables when selecting value stocks. Return on equity, or ROE, measures a company's ability to generate profit from its shareholders' equity. A higher ROE indicates that the company is using its equity efficiently. For penny stocks, a high return on equity could be a good sign of a solid management team. Positive return on equity is a must, but an ROE of over 20% is considered strong. Last but certainly not least, shareholder yield is a measure of how much cash is returned to shareholders through dividends, stock buybacks, or debt reduction. If a company has a high shareholder yield, it's returning a good amount of money to its investors, which could be a positive signal for long-term holders. What's a high shareholder yield varies from industry to industry, but seeing a positive percentage there is always a good sign. I prefer to see between 3 to 5% shareholder yield whenever possible. And there you have it, 10 stock fundamentals you should know the values of before adding any penny stocks to your proverbial cart. Understanding these metrics will help you know what you're buying before you buy it. I hope this helps you make more informed trading decisions and helps you avoid getting burned by hype. Stay tuned for my next videos where I'll be breaking down how you can find this information and apply it to your own penny stock research. Thanks for watching!